my pleasure to welcome Josh Reed, who is an associate professor in the operations group at NYU Stern. His research is focused on problems in applied probability and more specifically queuing theory and revenue management. He has published in well-known applied probability and operation research journals, such as the Annals of Applied Probability and Operations Research. He was also the recipient of the George Nicholson Prize awarded by Informs and the L. Long Prize given by the Applied Probability Society.
Thank you. Okay, so thank you for inviting me today to give the talk. It's very nice to be here at Tandon. I've actually never had a chance to visit in all these years, so it's very exciting, actually, very exciting. Okay, so the title of this work is Modeling a Two-Sided Limit Order Book, and this is joint work with a colleague of mine, Peter Lackner, who's in the statistics group at Stern, and a fabulous PhD student also, Julie Yang, who is so good that after he graduated, he got poached by to go work at Amazon. So he's now working at Amazon, doing other types of research for them, but he was very, very talented, and he helped us a lot, actually, in writing this paper. Okay? So let me start off with a little bit of some motivation. So this first sentence actually is kind of somewhat outdated at this point. I mean, modern equity markets have experienced a fundamental change over the past several decades. Trading is now organized mostly around order-driven limit order books. Okay, that's certainly true nowadays. It was the change probably happened over a decade or two ago at this point, but nevertheless. If you look at equity markets, trading is essentially organized around what we call limit order books. And that's something that I'll describe exactly what that is in a moment, and it'll be the focus of the talk. It actually also turns out to be true, this is sort of the more modern sort of part of this slide, that even if you look at the crypto space, you also see limit order books. Okay, so if you look at like some of the major exchanges, like a Binance, Coinbase, FTX before when they did exist, which somewhere in the middle of this research they went bankrupt. But they all use limit order books to trade the currencies, essentially, right? Cryptocurrencies. Okay, so that's another example of where order books are used. Now, it is true that there's also within the crypto space a whole different mechanism to set up exchanges by, which is what's called decentralized exchanges or decentralized finance. There's no more limit order books. A limit order book essentially gets replaced by something that's called an automated market maker. And that's a whole different story, a whole different paper. And actually, my PhD student, Gustavo Gruval, is here as well, and together we're working on some automated market maker papers. It's all kind of bundled. The DeFi automated market maker approach and the limit order book approach all fall underneath the same umbrella as what people would refer to as market microstructure. But the focus of the talk today will be limit order books. Now, one challenge that sort of arises when you try to model a limit order book is the dimensionality of the state space. Okay, there could be multiple prices, lots of a huge number of orders on the book, all at different prices, and so there's a lot of information that you need to keep track of, right? If you wanted to model the order book exactly, there'd be a lot of information that you need to keep track of. And that can make things obviously very difficult from a modeling perspective. And so a lot of papers that you look at will just model what's referred to as the top of the book, let's say. which is essentially the best bid, the best ask, and how many orders are at each of them, right? So there you have a two-dimensional state space. And by the way, feel free to ask away with whatever questions you might have. So the kind of the motivation for this work, actually, it's just kind of a long story. So around the time that we started this work, this work is actually the third paper in several iterations of the same problem, in which we were progressively kind of getting closer and closer to what we wanted to, and then finally we have it with this paper. So it started actually, these papers started about 10 years ago already. And at that point in time, a lot of people in queuing, which is where kind of I came from in my PhD, at that time, a lot of people in queuing, kind of one of the fashionable things to do in queuing was to use measure valued processes to model queues. And that's because there's certain queuing disciplines that require you to sort of keep track of a lot of information, right? First come, first served wouldn't be an example of that, but other things like shortest remaining processor time or processor sharing models, these all require knowledge of kind of each customer in the queue and how long they've been there and what their service times are and all this information. And so a lot of people were using measure valued processes back then to model these types of systems. And so we were kind of like, well, can we maybe transport some of that to the limit order book setting? Limit order books, there's a lot of there's a connection with queuing, an inherent connection with queuing, because orders come in, orders come out. It's kind of, if you look at the total number of orders on the book, it's kind of behaving like a queue might. And so that was sort of the motivation a long time ago, right? And so that's what I'm going to talk about today. Now here actually is an example. So I'll tell you exactly more about how the order book behaves in a few slides, but this is just a snapshot. So one of the nice things about the fact that in the crypto space, these big exchanges are driven by order books, is that the exchanges tend to just give you all the information for free, right? It used to be in equities, it's very expensive to buy order book information, like very expensive, like I can't afford it, right? But in crypto, they just give it to you. You can get whatever you want, the whole order book, free, instantaneously, in real time, right? So it's kind of really cool. So this is actually a snapshot from 2022, April 16th, of the coin, the Doja coin versus US dollar limit order book on Coinbase. Okay, and the way that this works is, and I'll get into very specific details of our model in a moment, but essentially these red lines are orders to sell. Right? The green line is orders to buy. Okay, these are limit orders to sell, limit orders to buy. People want to sell at a higher price than people want to buy, right? And down here you see the price that in dollars. This is a currency exchange. Okay, so we have two currencies. The sort of x-axis is the price in dollars that people are willing to buy a coin at, one coin, okay? Or I think it's like one coin. So it's like 14 cents, something like that. Doja coin, if you remember, if you know anything about crypto, it was like, people would own like trillions of Doja coins because it was priced so little. And the y-axis is how many really cumulative orders for Doja coins are placed at these different values, right? So every time you see a jump in this green line, that's like how many, there's like maybe 2 million Doja coins that people want to buy at around 14 cent, 1.1462 whatever it is dollars, right? So it's a big order sitting there. Okay. Then you have another little tiny order right here for some more Doja coin at a higher price, bigger order, etc. Okay. This is sort of a cumulative view of the order book. Okay. And just to sort of put some more terminology out there that we'll use in the rest of the talk. This is sort of you see this, there's a little order placed right here. So that would be what's called the best bid. Okay, that's the highest amount that someone is willing to buy a coin at, and that's about 14.66 cents, right, at this point in time. And the best ask would be the lowest amount that somebody wants to sell some coins for, and that's around $14.7 cents, right? A little confusing because everything's in cents, right? But and so you have and in between is what you would call what people would call the spread, difference between these two. Okay, so this gives you sort of a a visualization of what a order book looks like. Okay, so let me describe what we're going to talk about today. So I'm going to propose a model of a limit order book where you have two sides of the book, the bid and the ask side, and each side is going to be represented by a measure. Okay, that's sort of a technical term, but basically it's like an infinite dimensional object that can keep track of every order and all the different prices that they're at. Okay, so we're going to have two measures, one for the bid, one for the ask side, and the dynamics of how these measures behave is very confusing, very difficult to analyze in this what I would call the discrete model, okay, the sort of non-asymptotic model, right? And so what we do, and again this is something which was completely borrowed from queuing theory, is we analyze the model in what we call a high frequency regime. And this is a regime which I'll define technically in a moment, but essentially what it is it's a regime where the rate at which orders are coming in is very fast, okay, hence the term high frequency. Orders are coming in every nanosecond or whatever it is, and the orders are being placed very close to the best bids and the best asks. Okay, so you can think about that as being that, and the spread is very, very small. And this is typically the case for stocks that have high volumes, right? You look at equities. If you look at Fortune 500 companies, high volume trading, high frequency, small spreads, et cetera, et cetera. Okay, this is not good for if you were trading penny stocks or something like that, or illiquid type of assets. Okay, and so what I'll show you later on in the talk is that in this asymptotic regime, if you take things to the limit and then you do some scaling, what you find is that the order book ends up getting characterized as the solution to a pair. So there's two equations, because one for the bid and one for the ask. But what you get is a coupled pair, so they're related, they have some relationship to one another, the equations. But you get a coupled pair of measure-valued stochastic differential equations. Okay, so you can think about this as infinite dimensional stochastic differential equations, which are somewhat formidable, okay? But it turns out that we can characterize the solution to these systems of equations. And the solution depends on the model parameters. What I mean by that is that the structure of the solutions depends on the model parameters. So there's a dichotomy depending on the model parameters of what the solution looks like to these equations. I'm going to try to go through all that, as best I can. Okay. Yes.
So just for clarity, is the behavior of the market orders, is that exogenously specified and completely independent of the price movements? And what about the size of the orders?
Okay, great question. So the market orders, so first of all, the arrival of, we'll see it in a moment, but the arrival of orders to the order book are all exogenous. It's very simple. They're just independent Poisson processes. I mean, that's not because we can't do more. It's just that we kind of have our hands full already, and so we want to kind of strip out that type of stuff for right now, So there's 4 arrival processes. For each side of the book, you have market and limit order, and then you have 2 sides of it. So there's 4 Poisson processes. They're all independent of each other. Now, market orders is no problem. They just arrive. They take the best from the best bid or the best ask. And we assume that every single order is of size 1. Again, for simplicity, we could handle random order sizes. Most likely what would happen is that it would just be that in the limit, the expected order size would be the only thing that mattered. But to make things easier, we just get rid of that.
Well, so if they're a large trade, they came in randomly, that could easily sort of change behavior, right, in the marketplace.
Oh yeah, no, absolutely. So yeah, no, there's no doubt. So there's a lot of feature. I will say, right now that there's a lot of features in the model that there's a lot of features in reality that aren't represented in the model, and that's again because quite difficult to handle what we had in front of us. We wanted to just really understand the essence of the model before we start adding other features. Now, the only thing which is somewhat endogenous within the model, we'll see this in a moment, but when a limit order arrives, it strategically not strategically, but it places its order depending on the current state space of the book, depending on the state space of the order book. So the limit orders that arrive do depend on the current state of the book. You'll see that in a moment. Any other questions right now?
Question, well,
Yeah.
why would you say that at a given point in time, why would the representation of the current order book in infinite dimensional object, isn't it basically discrete number of values and how much you got outstanding at each?
Yeah. So I guess at any moment in time, it's finite dimensional because there's only a finite number of orders on the book. But you sort of need an infinite dimensional, or at least a countable state space for this because there's no limit. There's no upper, as far as I know, there's no upper limit on how many orders can be on the book. So you need to be prepared for all of that. So you need a infinite, countably infinite at least, dimensional state space for that reason alone. Right?
And it would be silly to sort of say, pick one price and just simply look at the evolution of how much interest there is at that one fixed price, so you have a single dimensional stochastic process. It wouldn't make any sense to do that, right?
I mean, there's papers that again they basically just look at the best bid and best ask prices, so they ignore anything deeper in the book, and they're wonderful papers and they have wonderful results. So I don't want to say that that's a silly thing to do. We were just more interested in several we wanted to see what we could do as far as like extending the state space, and how would that turn out really. Okay, so this is literature review. For time, I go quickly, but if you kind of look at a very high level, at the entire literature on modeling order books, there's maybe you can say two approaches, but of course there's probably more, but broadly, very, very broadly speaking, there's two approaches. Kind of like there's an economic approach, economists who tend to model order flow as, these are like static models where you have rational agents who are arriving and trying to maximize some sort of utility for themselves, and that's how they decide where to place their orders. And then you have a second approach, which I think is more our approach, which models the order book as a stochastic process, where orders arrivals are random, agents might have zero intelligence, okay, and these types of models are more interested in statistical features of how the book behaves. This is a whole sort of bunch of papers on the topic, but there's many more. So, okay, so let me sort of describe the model. Hopefully, things will come into more focus at this point. Okay, so essentially, as a picture, this is what our model looks like. Okay, so we consider the buy and the sell side of an order book. As I said a moment ago, every order is of size 1. Okay, they're all of size 1. They're just like little chunks, little blocks. Okay, and the ask side, here we have 10 orders. Okay. 3 of them are stacked at the best ask, right? Because this is the lowest price someone's willing to sell for. 2 of them are, let's say, suppose this is an equities exchange, the tick size is pennies, okay? So these 2 orders are, let's say, a penny more than this one, and then you have 5 more orders over here, which are 2 pennies greater than the best ask. Okay. And then I have my bid or buy side of the book, where there's 1 order at the best bid, 1 order behind that one, okay, 4 more, and 3 more. Okay? So this would be the state of the book at this point in time. Okay? In the model, there's only a finite number of orders in the book at any point in time, but they could be, who knows where. So we need to keep track of everything. So you can think about this as a measure, okay, in the following way. So at every point in time, we have these 2 measures, mu B and mu A, bid, ask, okay, at each point in time. These are, if you want to think about them, you could think about them as being, you can think about them as being counting measures, okay? And what happens is that for every Borel set on the real line, you can look at the measure of that set according to the bid side of the book at time t and the ask side of the book at time t. And what this will give you a real number, right? And in this case, an integer, actually. And it'll tell you how many number of buy orders are on the book at time t whose prices lie in this set A. It doesn't have to be an interval, it just has to be a Borel, some Borel set, right? And the ask side of the book measure, its measure of this set, would tell you the number of sell orders, limit sell orders, of course, on the book at time t, whose prices lie in the set A. Okay? And so what I want to describe to you now is how these measures evolve. Okay, these measures are going to be a dynamic system that evolves over time randomly, according to very, very specific rules in our model. Okay. So the first thing to do is to recover the best bid and the best ask from these measures. Okay? So the best bid is essentially the lower limit of the support. The best bid is the upper limit of the support of the measure representing the bid side of the book, right? It's the highest amount that someone's willing to buy. And so that's given by this little supremum over here, okay? So if I give you the mu b, the measure representing the bid side of the book, you can recover the best bid by finding the upper limit of this measure's support. And the best ask at time t is given by the lower limit, right? Because it's the smallest amount someone's willing to sell for. And so that's PA of t, the lower limit of the ask side. Okay? So this notation will be PB and PA. These PBs and PAs are going to play a role throughout the rest of the talk. Because one of the things we're interested in is how do the prices evolve over time. We want to know how does the whole book evolve, but at a 2-dimensional level, how do the prices evolve? Okay, now, how does the book evolve over time? So first set of rules. So market sell orders arrive to the buy side of the book according to a Poisson process. There's 2 Poisson processes. So one of them has a rate lambda bn. That's buy market orders, okay? That's the rate at which market orders to buy arrive to the book. And then we have a separate Poisson process with the rate of lambda am. That's the rate at which market orders to sell arrive to the book on average, okay? And each time that one of these market orders arrives, it's for just an order for 1 unit of whatever it is, the stock, okay? And it just removes 1 order from the book, okay? So here's some little diagrams to sort of help us visualize this. So suppose the book is in this configuration right here, which is what I showed you 2 slides ago, okay? And a market buy order arrives. So, a market sell order arrives. Okay, so suppose a market sell order arrives. What's going to happen? Pop quiz, right? So what's going to happen is it's going to remove one of these orders from the best, that's at the best bid. And so the book will transition into this state right here. Everything's the same except for I removed the 1 order that was there before. Now in particular, in this case, the best bid did not change, the best ask did not change. The only thing that changed is now instead of there being 2 orders at the best bid is now only 1. But everything else kind of stayed the same. Now, if immediately after this, another market sell order arrived, Well, then we would go from this situation to this situation. And now, of course, another order was removed from the bid side of the book, but also the best bid changed, right? The best bid decreased because now it's this. This is, let's say, a penny less than that. Okay? That's sort of rules number one, okay, for what's going on here. So this is going to be happening randomly all the time in our model. Now, we can't just have orders being taken off the book all the time. That would be a very simple model. So we have to have orders being put back on, right? So how do orders get put back on? Well, that's what we call limit sell orders. That's where the term limit order book comes from. And so these limit sell orders also arrive independently according to Poisson processes as well. They can have their own rates. So lambda AL, that's the rate at which limit sell orders arrive. Lambda BL is the rate at which limit buy orders arrive. And so what's the rule here? So this is where we have some endogeneity in the model, okay? So let me explain to you in words first what happens, and then we have this little formula here. But basically what happens is when a limit sell order arrives, right, what does it do? Well, it needs to figure out where it wants to place its order, right? It can choose whatever price it wants, right? That's why they call it a limit order. It's basically you say to the exchange, I want to sell this stock, but I'm not willing to sell it for any less than this amount. That's what it means to place a limit sell order. You know, if you're just trading on whatever it is, Robinhood or Schwab or something, you don't really necessarily know about all these details, but you place a limit sell order and you say, I'm willing to sell for no less than this amount. If it's more, it's great, but if it's less, no way. Okay. So how do we incorporate that into the model? So what happens essentially is that a buyer, let's say a limit sell order arrives, the seller kind of like looks at the best bid and looks at the spread. That's the difference between the best bid and the best ask. And says, I'm going to kind of place my order as a function of these two things. Right? First of all, obviously I need to take into account the best bid. I don't want to place a limit sell order for less than the best bid. That just gets converted into a market order immediately anyhow. Right? So you need to know kind of where that reference point is. Then the trader also needs to know the spread. Because if the spread is really large, you know, that's going to change, you know, where you decide to place your order. You might want to place it inside the spread, outside the spread, a lot of different factors. Okay. So this right here essentially incorporates all that. Okay. So essentially what happens is if a limit sell order arrives at time t, it places its order at this value right here. Okay. And so what happens is PB of t minus is the best bid right before the limit order arrived. And then it multiplies this by this quantity right here. The best ask divided by the best bid. Raised to the power of some random variable x, xa. Okay. Now, PA is greater than PB. So this thing is greater than 1. And you raise it to some power, this is not negative. So this is also greater than 1. So the best ask, the sell order will always be placed higher than the best bid. You don't have to worry about going into the wrong side of the book. Now, the thing is, this is random. This x is random. It's different for every trader. They each have their own x. Now, if you kind of understand a little bit more about this formula, is if xa is less than 1, then the trade will get placed inside the spread, and it'll become the new best ask. If xa is greater than 1, it'll get traded, the trade will be placed behind the best ask, and it'll just be some order that's deeper in the book. If the XA is exactly 1, you can see right away, the PBs cancel, and the trade's getting placed right on top of the best ask. Okay? So this is how that works in the model. And these XAs are all random, so every trader has their own.
So, I'm sorry, so you say that it gets placed in the book at that price?
Yeah.
Do you mean at that level, or you?
Yeah, at that level.
Okay.
Price, everyone think about it. Yeah.
Does it account for the tick size here?
No, yeah. So there's no accounting for tick size. Again, it's sort of too difficult. I mean, in crypto there is really no tick size. It's like 1/1 billionth or trillionth of a dollar. It's so small. It's negligible. In equity, it's a little bit different, but we can't. Yeah, too much nitty gritty for the model. Yeah.
expected the arrival intensity to depend on the spread? Or any reference price, mid price, whatever?
Yeah, again, we kind of had enough work on our hands to just deal with like the results in the very vanilla model that we didn't incorporate that. But I imagine it's, you know, I didn't try it, but it seems like it could be incorporated to at least get some sort of limiting system of equations. Now, whether they could be solved, to what extent they could be solved, we don't, that would be not, I don't know. But yeah,
So how about cancellations?
there's no cancellations either. That's another thing. Cancellations very easy to actually incorporate. It would just, we have some reflecting Brownian motions later on in the paper. Those would just become reflecting OU processes. That's actually part of my PhD, reflecting OU process. So that's, but we didn't even go to that far. We just,
So it's the properties of this random variable determines the evolution of the best bid and best estimate, right?
yes.
Correct?
Yes, and when I said a moment ago that the structure, so we get the same system of equations regardless. The structure of the solution to that system of equations depends very delicately on the expected value of the log, actually, of this random variable, and there's a corresponding one for the other side of the book. In particular, whether the expected value is positive, negative, and the combination on both sides. That affects the structure of the solution to the limiting SDEs. But yes, the answer to the question is yes, it's very dependent on this. Yes.
Thank you.
Okay, so the ask side of the book behaves just in sort of, let's say, the opposite way, but same, you know, just flip everything around, okay? Yeah.
You probably have a lot of data related to this one. Does that, corresponds to empirically, how to they place, limit orders?
I not so don't know.
Okay.
Yeah, I mean, we just, obviously, it's very, makes the model tractable and helps us out a lot to model this way. Okay, so really quickly, because I want to try to get to the main results, but, here's sort of how things would work. So if the book looked like this, and a limit sell order arrived, and it placed an order below the best bid, so that XA was like less than, greater than 1, then, the price, it might go there, right? And then if another limit sell order arrived and the XA was less than 1, then the order would be placed inside the spread. It would be, let's say, right there, and now the best bid increased by 1. Okay? Or whatever amount that would represent of an increase. Okay, and then finally, the last thing is, for somewhat technical reasons and also maybe realistic reasons, we have a market maker who doesn't allow the number of orders in the book to drop below a certain amount, right? So the number of orders in the book is always positive, never 0. And essentially, if someone takes an order off the book and the number of orders drops below some level, or let's say someone takes a limit, if a market buy order comes in and takes a limit sell order off the book, and the number of orders drops below some level AA, right? This is some positive number, then the market maker immediately replaces that limit sell order wherever it was. Okay? So you never have an empty book, right? Without a best bid or best ask or something like that. And the same thing happens on the bid side of the book. Okay, so let me now talk about the regime, and then I'll show you the limiting system of equations, and then I'll try to go over the solutions a little bit, but it gets like there's a lot of notation that kind of ends up flying around, so I just want to give you a basic taste of everything, okay? So, so this high frequency regime is technically defined in the following way. I mentioned already there's really 3 components to it, right? First, the rate at which orders arrive has to be really large. And so what we do is we consider a sequence of models indexed by some parameter n, where this n is going to infinity. And essentially, the arrival rate of orders in the nth model is big O of n. Okay? But the lambdas, so in particular, lambda b, so n times lambda b is approximately the rate at which orders are arriving to the buy side of the book. that's buy order, that's limit orders, wait, that's market buy orders and limit buy orders, yes. And lambda, n times lambda a is the rate at which orders, limit, and market orders are arriving to the ask side of the book. So essentially, not only in this regime is the rate at which orders coming in really large, but it's also approximately balanced on each side of the book. Okay? So roughly speaking, market orders and limit orders are coming in at approximately the same rate on the bid side of the book, and then on the ask side as well. Right? Although the actual rates can be different on the bid and the ask. But on each side, they're approximately the same, and it's very large, a big O of n. And there can be a slight imbalance of order square root of n between the rates, and that's captured by this parameter theta. It just adds a drift to a Brownian motion later on. You don't have to have it, you can make it 0. Easier. Okay, now the place, the location of where the buy and sell order, the limit orders get placed, I said is close to the best bid and best ask. And so the way we do that is this x random variable in the nth model is like some random variable x that doesn't change, it's always the same, but it gets raised to the power of 1 over square root of n, which is approximately 1 plus the natural log of this x divided by square root of n, if you do a Taylor expansion. So this is right around, very close to 1, but small little difference of order 1 over square root of n. Okay, so there's still some movement. Okay, and that's on the bid and the ask side. So essentially, if you do this Taylor expansion and you work everything out, you see that like a limit order arriving at time t in the nth model, a limit buy order basically gets placed at the best bid, plus some 1 over square root of n modification, which looks something like this. The natural log of the x comes into play. Then there's some remainder term.
What was X? I'm lost.
X,
So-
yeah. So that, I know there's a lot going on. So basically, X was right here.
Oh,
Right.
the random variable.
The
Yeah.
random variable that tells us sort of where you place it.
The
If X is,
combination in logs, right?
what's that?
The combination in logs, in log prices.
No, the actual price. This is geometric, so this is the actual price. The log comes into play because we do x to the over square root of n, and then a log pops out. But this is the actual original.
Now, in the sense that if I take the log of this, I get 1 minus x theta log of PA plus x theta log of PB, right? Is that
I
correct?
think so. That sounds about right. Yeah, you can take the log and yeah. It'll be more like linear if you take the log. Okay. Okay, and then the last part of this high frequency regime is that the market maker, the number of orders on the book is roughly square root of n in this nth regime, because the rate of orders are coming in as n on both sides. It's like a central limit theorem, so the total number is approximately square root of n. And so the market maker kind of raises his lower level. So he kind of keeps the number of orders on the book at sort of a square root of n level. Okay, so let me show you the system of equations. I don't have time, I don't think, to go through every single possible solution, but just quickly. So what we do is we look at these scaled order books now, where we don't scale time, we just scale space. So, or really the mass of each measure. So each measure is, in the nth model, the entire mass of each measure is approximately square root of n, which blows up. So we renormalize the mass of each measure by square root of n, okay, to keep things all nice and tidy. And then I define this inner product notation. So we're going to work with test functions to give you the measure value stochastic differential equation. And so for any bounded function, the inner product of that function with a measure is just the integral of the function against the measure. Okay? Okay, so main results regarding we didn't formally prove this because it's a huge headache, because we already proved this once for another paper which only had a one-sided book and it took like forever. So we don't actually prove it again in the current paper. We just formally derive it, but I'm willing to bet the house that it's correct. Everything's fine. So basically, okay, fine. If the initial measures converge in some sense, this is a weak topology in the space of measures. Okay, so if the initial measures converge, then the processes, the normalized processes, the pair of normalized processes converges as well, weakly. Okay, we're again using weak topology for the these are, this is like a CAD-lag measure value process. Okay. Okay, and so this pair right here is the solution to a pair of coupled stochastic differential equations that look like the following. So it's described in terms of test functions, and basically for every test function, if you take the inner product of that test function with the solution, mu tilde b and mu tilde a, you should get what's on the right-hand side. Okay, and really quickly, it's just okay, the inner product with the initial measure plus lambda times the expected value of those x's times some term that's essentially of, let's say, finite variation over here. Okay, it's, it kind of looks like the placement of the orders. Essentially, that's what this is. This is the placement of the limit orders on the book. And then you have a last term where this S tilde B is a reflected Brownian motion. But you just think about it as Brownian motion if you want to make it simple. I mean, it can't be that. It has to be reflected, but it's basically a Brownian. It's a Brownian nature. It just has a reflection there. And this represents the mass of the book changing. If you want to parse the equations, right? This is like the mass of the measure changes according to this Brownian motion. This is telling you how the kind of like where the new mass is being put is what this represents. It's where the limit orders are going, and this is just the initial point. And so you have a pair of equations, and what you notice is that they're coupled because the PA shows up in the equation for mu B, and the PB shows up in the equation for mu A. And that's because, remember, where you put the order depends on where the best bid is, let's say, and the spread, or where the best ask is and the spread. So the equations are coupled. You can't solve them independently. Okay? Any questions about this? Okay. So let me walk you through then the solutions. I have 15 minutes, okay? So I'm gonna try to show you, solutions to this. And it turns out, I think this third time I'm saying this now, but it turns out that the solution depends on the sign, positive or negative, of this expectation and this expectation. And so there's 4 possibilities. The signs can both be positive, both be negative, or they can be one or the other. Okay? I'm just going to show you the solutions if both of these are positive or both of them are negative. The other two is just like a very non-aesthetic combination of the two. Yeah.
PA and PB are as before the essential if of the support, essential soup of the support.
Yes, but of the support of mu tilde A and mu tilde B.
So you know they are finite.
The,
Maybe because after scaling, is it clear that they are finite?
well, so first of all, the result was we don't prove it. We just formally derive it, right? So we don't that technicality. It doesn't never became an issue. We never considered it, but I maybe we could prove that anyhow if we wanted to, that they would be finite. I mean, they're clearly finite in the solutions, so actually we don't know that there's a unique solution, I should say, to these equations. So that's sort of out of bounds for us, out of our reach. We just can give you a solution. We conjecture it's unique, but we can only give you a solution. In other words, we guess the solution, we verify it. Okay, so first case. So suppose that both of these guys are positive. Now, intuitively, what that means is that the orders are being placed, let me think about it. The orders are being placed into the book, right? Deeper in the book. Like they're not being placed inside the spread. Both sides of the book. So like, this would be a situation where somehow the spread got too small, right? And everyone's like, oh, the spread, it's too, like whatever, and people are placing, like, people are placing further outside. Okay? You should think about this as being like instantaneous situations, right? This isn't like this situation would persist for more than a short amount of time. right? Because everything happens so fast here. But there's some instantaneous moment in time where maybe the book got misaligned, whatever, some bad orders were placed or whatever. And now everyone is placing their orders deeper in the book because they think the spread's going to get cleared out really quickly, something like this, okay? I mean, that could be the story behind this, right? So in that case, then the behavior is a bit, I don't know what the right word would be to describe it. It's a bit, not degenerate, but it's essentially what happens in this case is that the best bid and the best ask, they just start moving away from each other, right? So, because everyone's placing their limit orders deeper into the book, the market orders are coming in and taking away the orders at the best bid and best ask, and everybody's continually placing their orders deeper and deeper. And so the best bid and best ask, they're monotonic. They're both moving in opposite directions from each other, and the spread just keeps getting larger and larger. Again, you should think about this as being some quick, short moment in time in which this situation is prevailing, right? And so you can characterize the solution to that STE in the following way. So essentially, the measures at each point in time, they look like whatever so on the buy side of the book, the measure at time t is whatever the original measure looked like on the buy side of the book up until wherever the current price is, because nothing has changed there, because the book the price hasn't reached that point yet. So those orders are just sitting there. And there's nothing below the best bid on the bid, above the best bid on the bid side of the book, because the price is just going to be moving upwards all the time. And the best ask, other way around, the price is going to be moving downwards. Okay? Now, the question that's interesting is, what is PB and PA? And so I can give you a system of equations that PB and PA satisfy. So PB and PA, the log of PB and PA, satisfies the system of equations right here. Okay, this is very simple. I mean, we don't have a solution except for special cases, but this is where you may custom just two-dimensional system of equations. Okay, and I don't want to get into the details, but this alpha B and alpha A, there can be atoms at the best bid and best ask, and so that's like these alpha B and alpha A is like the size of the atoms that are there. Okay, it's like a lot of orders at the best bid and best ask. Now, we actually can solve this system of equations in some special cases. So, for instance, if we start out with an order book where the initial conditions are that all the orders are piled up at the best bid and the best ask. There's no depth to the book. Just everyone has their orders at the best bid and best ask. So that's the best bid and best ask are just atoms at the best bid and best ask. Then you can solve this system of equations, the system of equations on the previous slide. Well, so basically, you can solve for the natural log of PA divided by PB. This is just closed form sort of thing over here. Everything is known over here, right? And then you can just substitute this back into those other equations, and that gives you a completely explicit solution to the best bid and best ask.
Can you show again the previous slide, please?
Which one?
Can you show the previous slide?
Yeah.
If I go to log variables, isn't this a system of linear ODEs? A linear system of ODEs?
No, because there's the alpha B.
The alpha is
It's the mass. So there's this.
The alpha contains PA.
Yeah,
Okay,
it contains the
okay,
initial
thank you.
measure.
Thank
That's
you.
why if the initial
Got it.
measure is simple, the alphas go away basically. Yeah, and then we just solve it. Exactly.
Thank you.
Okay, so in the last little thing, what happens if both of these expectations are negative? Okay, in that case, the spread got too large, and everybody's placing their orders inside the spread on the bid and the ask side, right? They're all just placing orders inside the spread. Well, not everyone, because there's on average, we should say on average, people are placing their orders inside the spread. Okay. It's probably not worth going through everything here. There's a lot of stuff. This was actually the hardest part of the whole thing. Okay, things are really complicated. There's a whole lot of notation here. Okay, like I mean, none of this is like, this is just like the smallest number of orders, the smallest size of the book up until time t on the bid side, on the ask side, so the infimum of the best, basically an infimum of a reflective Brownian motion up until some point in time. Then you have some like hitting times. Actually, they're like last, I think they're called like last, it's the last time the price was at a certain level. That's essentially what TB and TA represent. The last time the best bid was at time X, was at the level X before time T, and the last time the best ask was at the level X before time T. That's what these things are. Okay, a whole bunch of notation there. And then there's a little bit more notation. By the way, we actually had a simpler version of this. You guys are on it. And then we just were like, no, we need the full general solution, everything. That's where all this notation started coming up, because we actually have like total like everything sort of solution. But unfortunately, it makes everything really messy. It kind of obscures a little bit of what's going on. But so anyhow, so there's like, this is just like the tail measure of each side of the book, GB and GA. It's just like a tail measure, like a tail seed. It's like a tail measure of the bid and the ask. That's what these GB functions are. Then you have their inverses and all sorts of stuff. But so this is all stuff that like you can compute on. Like there's nothing mysterious about it. And so it turns out that in this case, the log of the best bid and best ask again satisfies a system of equations, but they're not ordinary differential equations. There's memory in them. So they have memory in them. And they look like this. This whole bunch of stuff. Important thing really is like this in here. So like you have to, in the integral over here, first of all, the upper limit of integration is random. It depends on the total number of words in the book. Second of all, in here, you're like looking at the price of like the best bid at the last time that the price of the best ask was at the level U. Okay? Now all of that, you don't need like you can like this is an entirely self-contained system of equations. The measures are not, well, they're somewhere. Oh, yeah, so this is an entirely contained system of equations. It doesn't need anything more to solve it, but there's some memory in it, which makes it a bit icky. All right? Yeah.
Yeah, if I got right, like intuition over the XB and XA, like would kind of enter a little bit, if there is some kind of dependence over the spread as you commented, there could be some kind of explosive behavior of like all the others converging for inside the book.
Either
So-
explosive or
Oh
attraction.
yeah, exactly.
Yeah,
It would
yeah.
either go into the book or explode outside. So if there is dependence on the spread somehow, yeah, it would cause some problem.
Well, yeah, so let's talk about this case, right? So everyone's placing orders inside the spread. And so you would expect that initially the spread is always positive, right? So you'd expect that the spread's just gonna keep getting like this, closer and closer together, right? But you have to also remember that when market orders come in and take orders off the book, the prices go back out. And so in this case, actually the prices are gonna go in and out, in and out, in and out. There's gonna be like really diffusive, there's gonna be diffusive elements. The prices are gonna be diffusive because they're gonna go down when there's more limit orders coming in than market orders, but when the situation changes, they go back out. Of course, that's happening instantaneously all the time. So it's diffusive, right? It's not, the prices don't have bounded variation anymore, right? They're diffusive, okay? Like, but you can kind of think about them like going in like this, like, right? Okay? And so, yeah, so, and then we can also actually, so this is what we kind of really took a lot of time on, is that actually you can also characterize the entire measure at each point in time. And that's changing as well, all the time. And let's assume the measure is absolutely continuous. You can describe its density at every point in time, and it looks something like this. And the interesting thing about this is that essentially the density of the book is like a history of what the previous prices were. It's like you cut a tree and you look at the rings and it tells you all about what happened in the past. So the profile of where the orders are in the book is like a history of what the prices were in the past. And that's, you see these last price hitting times showing up in it. There's not enough time to go through all that, but that's sort of what happens there. Okay, so last thing in my little amount of time left is that we cannot, in a special case, we can solve this system of equations. Very, very special case. But actually, more interestingly, so it turns out that there's a unique solution to this system of equations, okay? And the proof, it uses a contraction mapping argument. And so actually, what you can do is, believe it or not, you can approximate the solution to the system of equations. So you just apply the contraction mapping like once, twice, 3 times, 4 times, whatever. And essentially, you're just getting an expansion of the solution. And that's not hard to do. And so we actually did that. So this is the details of that, of how you would do that. So this is like what the full expansion would look like if you wanted a solution to the system of equations. And then we tried it out. And so I think that's my last slide. So this is actually how good the approximation performs for the prices in this regime, when the both are negative. So the blue line, this is best ask, best bid. The blue line is the true, we simulate. So the blue line is the true value of the best bid and best ask. The orange line is our approximation using one iteration of the contraction mapping, so first order approximation. And the green line is a second order approximation. And it's interesting, I didn't think about this at first, but it actually looks, and we didn't prove this, but it looks like the first order approximation is a lower bound, and the second order approximation is actually an upper bound. In both cases, I don't know if we just got lucky or what. I doubt we just got lucky. So it's probably very possibly true, but it definitely was true in our numerics. Okay, so that's now. You could argue that maybe the other cases are more interesting, the mixed cases, perhaps, I don't know. That's kind of like there's some momentum, right? Where everyone, the price is rising on both sides, or there's, right, if people in that case, you just have a hybrid solution. You just have a hybrid solution to the system of equations that mixes the two solutions I showed you together. We have it in the paper, by the way, the paper is still being polished, but you can do that as well. Although we didn't analyze. I mean, but we
So
can do
that's
this. Yeah.
one of the blue is it's difficult to read. PB is the blue, right?
Yeah. So
The bid price, and the green and the orange are first order and second order approximation of the ask price
the bid.
of the bid.
So we simulated the best bid in a model, right, on a computer, and we got the blue line. Then we approximated that blue line
First order in which parameter?
So here's the natural. This is the natural log of the best bid. So it equals the initial natural log of the times 0 plus this series expansion.
Right.
And these operators A and AB, I defined them somewhere. They're defined right here, and they only depend on the evolution of the number of orders on the book. Okay. And the history of the price process, right? And no, sorry, and the not the history, the history of the total number of orders on the book. So you only need to know the path of the total number of orders on the buy side of the book to construct the approximations. You don't need to know anything about the price to construct them. I mean, that's what you're trying to get. And so you have these infinite series, and so we basically truncated the series after one term and after two terms.
Yeah.
And then that gave us, so basically, and that gave us after one term is the orange, and two terms is the green. You can see that the green is closer than the orange, second order versus first order approximation. But it's a lower bound versus an upper bound, which is nice because you can sandwich, where the price is. Any other questions?
crypto market or the equity market?
No, this is just on a computer. Like we just simulated okay, sorry, I didn't explain all that. So we simulated the original sort of what I call discrete model with some very high rate at which orders are arriving and a very small displacement of the orders around the best bid and best ask. I don't remember the details, but we simulated that. That gave us the blue curve, the price, but then we approximated that blue curve by just looking at the evolution of the total number of orders on each side of the book. And that gave us the green and the orange curves. Yeah.
Can you estimate the intensities from the, you have the data, right? From the crypto, like the crypto funds. So you could.
Yeah, I mean, I think you can get like everything, like from these exchanges. You can get like, I mean, I just showed you, so that little graph I showed you is kind of cute because like you look at it and it's like moving all the time, like wiggling around as orders come in and come out and whatever. But I'm pretty sure you can just download the entire history of transactions on the book. In some sort of data.
Estimate the number, right?
Oh, yeah, you can estimate the arrival rate of orders. And, I mean, it might not, it's probably not going to be, it'll probably be non-homogeneous, right, the arrival rate. So I'm not sure if like, this model would exactly work, but yeah, absolutely. And yeah. Any other question?
Excuse me.
Yeah.
So, could you go back? So the equation of the convergence, it's just a formal equation, or you prove it rigorous?
I forgot I had some other stuff, whatever, okay. Just some other stuff, but yeah, you're talking about this. This?
No. Too far away.
Oh, this way?
No.
Oh, I see.
Convergence. Yeah,
This?
one, yeah.
Yeah, no, we proved this because, so it's a contraction mapping. So we proved that if you just keep doing this over and over and over again, you're gonna converge to a solution. Now, there is a caveat, which is that the approximation, it's like kind of, I think it's, I have to think about it, but like we only do it up until, we kind of bootstrap it, so we do it up until some point in time. The contraction mapping, we said prove that there's a solution, unique solution up until some t. Maybe you can think about t as being small. Then once we have that, we do it again. So I think I think it's like technically this might only be valid up until some time, but it seems to work pretty well. Anyhow.
I want to ask, what if there isn't a market maker? I mean, the market maker has a limit in our model, right? But what if there isn't a market maker?
So the number of words can go to 0?
Okay.
Yeah, no, that's a problem. Because, so if there's not a market maker, what happens is that, you see, so as the number of orders goes to 0, the,
Not even the spread is defined, right?
what?
Not even the
Well,
spread
yeah, no,
is
that's,
defined.
yeah, I mean, that's one issue, but that's not, I mean, the limit, like, the vague measure of the amount of time that the order book is at 0 is 0. So you can kind of maybe get over that by just continuity, right, in terms of the price. But there's a different problem, which is that the price starts moving super fast, if I remember correctly. This was a problem in our previous paper. Basically, the price starts like really increasing quickly or decreasing quickly, like it gets like out of, like volatility like goes crazy, essentially, you think about it that way. So it's just like not good. Yeah. I don't know, I doubt that the limits would hold in that case. Yeah. So, yeah. Okay, thank you. Thank you.
And by the way, this is our last seminar of the year.
Oh, okay.
Thanks to all the speakers.
Oh. to meet you. Okay. Second year PhD student.
Hello, sir. How are you?
I need to stop the recording.
I want to return to academia.
Okay, sure.
Yeah,
Yeah.
for PhD.
Right. Yeah.
Yeah, I know STEM business was very popular in France, so I want to ask you have any advice
Oh, so you're so I'm in for
How long you staying in Morocco,
full
by the way?
disclosure, I'm in operations. I'm not in
Oh, that's very
the
good.
finance department, but
what's your
yeah. But I also do other things too. It isn't,
Sylvia was there, I told you. She went
I mean, it's not, you know,
Peace Corps.
you just have to apply. I don't know what else to say. I mean, it's like the normal stuff, like.
We should go, let's do an offsite, we should do an offsite in Morocco. Why not?
Schedule similarly.
I was gonna say, yeah.
Okay, so in the operations.
Yeah.
It's,
Pose that to the,
it's really helpful to have
big
resources.
range of the administration.
It's good to have,
Well, my friend went to a derivatives conference in Cape Town.
more and more, it's like becoming important to have